Hey, good morning, everybody. Thanks for joining us today. Dave will be with us just momentarily. You'll notice that from the video that we're not at the office today, coming from home. We're going to take a little downtime today for the weekend and get away a little early. So I want to thank you for joining us today. Remember that as you look at the link for this post, you will see that we've got a link to our report on understanding market corrections. I want to make sure that you check that link and get a copy of that for yourself. So take a look at that. Dave will be with us in just
0.7 Light FM, Steve Perry. Oh, Sherry. I'll have what she's having. Wrong movie, sorry. 8:39 here. It's time to check in on your money and find out what's going on Wall Street. It was looking pretty good earlier this morning, looked pretty good yesterday, but things might just take a turn this morning. Let's find out why. Phillip Statler is from Statler Financial Services in downtown Sebring, operating from home this morning as you're going to take a little trip this weekend, right, Phillip?
Yeah, going to take a little long weekend, and the kids are all in, so we're going to spend a little time up with Mickey Mouse and see how he's doing up there for a couple days.
Well, say hi for me while you're up there. We start the morning out with the jobs report. This is late because normally we get it on the first of the month, but the first was on a Saturday, so we're actually getting stuff that we normally get in the first 3 days of the month, 7 days in. The first of all, let's do the good news. The monthly unemployment rate holds steady at a barn-burning 3.6%. And everything else becomes crapola news because the ADP kind of gave us warning on Wednesday. We only gained a total of 75,000 jobs last month, according to the government. And I'm just assuming the market expected a ton more than that.
Yes, sir. They sure did, man. They expected 180,000 new jobs. And so that's a significant miss. I mean, more than half. More than a 50% miss when it comes to jobs. And so that just shows another peg on our graph that says basically the economy is starting to slow down.
Yep, it's drawing the picture that you and I have been guessing at now for months. We're doing okay, but we're slowing down. I mean, the unemployment rate itself says that people are hanging on to jobs and companies are holding on to employees. They just aren't expanding and creating more. And the government also revised prior month gains down in terms of job ads, and they said that wage growth slowed substantially last month as well.
So all those things, right, indicate a slowdown. And not that we've stopped or not that we're going backwards, but just that our growth rate is starting to slip a little bit, and we're not growing as fast as we had been growing in the past.
Absolutely. Yeah, the 3.6 is the indication that we're doing okay. The growth rate indicates the fact that we're not growing, and that down the line, that's going to be troublesome because we have to absorb a couple of 100,000 people entering the wage force every month.
Well, we do, but the other thing you have to remember, too, on the other side of that, the flip side of that, one of the reasons that number is not moving any is because you've got people retiring. So you've got people coming in, you got people leaving. Now, I did see that IBM is laying off 1,700 employees. So, we're starting to see some of that start to happen, and that will eventually start to affect our unemployment number.
Absolutely. The layoffs will hit hard, and we're probably going to see more of them in the tech sector as we continue to have disagreements with China with less use for people to do stuff when they can't get anything shipped in.
Well, and we hope, again, that we're going to get that under control between now and the end of the year. I mean, I think I saw a little blip yesterday that I haven't seen any confirmation of it, but I saw a little headline that Trump was putting off the tariffs on Mexico a little bit, pushing them back a little bit. I think they're seeing some indication that Mexico's trying to appease the president and stop the immigration into our country. So I think that maybe as we see some positive information coming in from that side, that the White House may continue to delay those, which would be a good thing.
Yeah, Mexico could have a substantial impact only on the grounds that we have so many big ticket items assembled in Mexico. The story that got things going yesterday, got optimism up, was Mexico's offer that the negotiations are getting leaked right and left, that Mexico is now willing to devote some armed forces efforts to try to guard their southern border with Guatemala. It needs to be mentioned that the people that are coming in across our southern border, yes, some are Mexican and are of Mexican nationality, but a big chunk of them are coming up through Mexico, all the way from down in the Central American countries like Guatemala, where they have political unrest, walking all the way through Mexico, and then coming across our border as undocumented aliens. And Mexico yesterday let it leak that they were offering to guard their southern border better, and that got us optimistic as the day was not bad. The Dow was up by 181 points. NASDAQ was up by over 40, and the S&P was up by 17. God was in his heaven, and all was right with the world at the time that we closed the markets yesterday.
Yeah, it was. We had a good day yesterday. The only index that continues to be in the red as of yesterday's close was the NASDAQ. Is in terms of the last 12 months, they're still down a little less than 1% right now for the year, but ultimately still down.
And it needs to be noted that they were the smallest gainer among the three indexes yesterday as well on a percentage basis. And a lot of that is the fact that we mentioned this a few days ago, that NASDAQ is getting hit. Their big holdings like Google and Facebook and the like, they're getting hit heavily by a whole bunch of other tech-related issues like regulatory problems from Congress and the like as well. So we may have a recovery period for NASDAQ, and the tech-heavy stocks might take a little bit longer than just trade issues because they've got some other problems as well.
Yeah, they do. You're right. The regulatory environment is starting to put some pressure on them for privacy issues and some other monopolistic things that they're looking at. Some people want to break up these companies, so they're coming under pressure on more than one front.
Understood. Hey, we did have some companies reporting and some business news to report on the individual stocks as well today, I gather, huh?
Yeah, we did. We had a couple of the newer IPOs are reporting their first quarter reports, and we've got the first one is Beyond Meat, which is a company that basically has created plant-based burgers, and they've done well. They only lost 14 cents a share. They're expected to lose 15 cents a share, so better than expected. And so revenue came in above the estimates. And I'm sure they're probably not on your big winners list, but they are a big winner today. They're trading up 26.5% before the market opens up. It'll be a new high for them at $126 a share.
You'll forgive me if I wait to buy a bean burger until I see whether it succeeds. I'm sorry, I got into an argument with a Facebook friend over the value of bison burgers. I'm a meat eater. What's next?
So the next one we have is DocuSign. DocuSign came in 7 cents a share for the year, or for the last quarter. That was 2 cents ahead of analyst expectations. Revenue came in above forecast, but there seems to be some concern with DocuSign and a slowdown in their growth rate. Now, not that they're not growing, but just a slowdown within the growth of that company itself. And so they're trading down 15% this morning.
Ouch. That's the electronic signing firm where you can legally bind documents over the internet, right?
Absolutely. I mean, we use them quite a bit. Mortgage companies use them quite a bit. So
that's what I figured. That was the growth industry. It surprises me with them showing a miss.
Well, they didn't miss. They're just looking ahead and saying, okay, our growth rate is going to slow down.
Yeah, miss rate on guidance, I guess would be a better term.
Yep, yeah, there you go. The next one we have is Zoom, which for those people who watch us on Facebook every morning, that's what we use to produce that video. They came in 3 cents per share for the first quarter, and that was 2 cents above estimates. So that was a pretty good deal for them on their first quarterly report. They revenue beat forecast. They had better than expected quarterly revenue guidance coming up for this next quarter, and they're up about 14.5% this morning.
Not bad. Yeah. Other indications before we start talking about the bond market, which is no fun whatsoever this morning.
So the last one I have for you today is in the retail sector, and that would be Guess, the retailer there. So they lost 25 cents a share for the first quarter. That was 1 cent more than Wall Street had anticipated. The apparel maker revenue was in line with what they had forecasted, and their full year forecast was above the current year consensus. But they're getting hammered. No, I'm sorry, they're even right now. They're basically flat at this point. So, which I guess is good given that report.
All right. Looking at the Treasury bonds this morning, that's going to cause some upset as well, as far as antacids on the markets are concerned, because the rates on U.S. debt is going down. That's probably good for the government because it's cheaper to borrow the money, but still at the same time, 10-year Treasury bills are down another 4 basis points in my report, and I think you had them even worse than that, down to 2.08, and the 5 years down to 1.83%. We're not at Europe yet, but we sure are getting cheap to borrow money for the government, aren't we?
Yeah, we are. Actually, I've got the 10-year at 2.062 right now. Yeah, and so it's dropped a little below the 2.06 a little bit ago, and it's popped back up. And so we've got that. Though, if you look at the yield curve now, I don't know if this is a good thing or not, given the interest rates are falling like rocks, but we don't have that inversion anymore. We got a 3-month that's higher than anything else. But the 1 year, the 2 year, the 5 year, versus the 10 are all lower than the 10 year. Now we do have a little bit of an inversion between the 2 and the 5 and the 1 year, because the 1 year's right up almost at 2%. And like you said, the 5 years down to 1.8. So we do have a little bit of inversion in those less than 10-year notes.
But still, like you said, they're falling. Even the 30-year bond has fallen by 5 basis points this morning. It's down to 2.59%. It's just interest rates. But the flight to safety is almost becoming a railroad car as it goes.
Well, yeah. The other thing that we didn't talk about yesterday, Dave, real quick, is that we saw mortgage rates at a 2-year low.
Huh?
Yeah.
And they were talking about them going up. I guess bonds are going to track the mortgage rates down too. That makes sense.
Exactly. Yeah.
45 minutes before we open, Phillip, the money's going somewhere. What's happening with the stock equities this morning?
Well, I'm going to give you these numbers, but they're not going to quite be right because I'm on a delay this morning too, and so my indicators are not going to be quite right. I know we're pretty much in the red, I think, across the board, but I don't have us there yet. I've got the Dow right now down $3. I got the S&P 500 up $1, and I've got the Nasdaq up 5, and I think all three of those actually right now in real time are down in the red. We've got gold and silver. Huh?
I was saying, looking at the trends, I think you're right.
Yeah, they're heading down. Gold and silver popping up, and then crude oil up 1.1% to $53.18 a barrel right now.
Still within the affordable range, though. Overseas markets, Asian rim markets generally up on optimism on the trade front. Ditto for Europe this morning. I got green ink across the pond. That might be the exception to our performance today. Phillip, somebody needs some advice to stabilize things and make sure your investments are in the right place for your station in life. I know you've got a quick report they can get on their cell phone with a cell phone text, and I know you're ready to make an appointment with somebody who needs help, right?
Absolutely. Since I'm working from home, I don't have that number memorized. So if you go to my post this morning or yesterday, there's actually a link within that post where you can get this free report on market corrections.
Hey, I got it. I can do that. It's 285-3815, 285-3815.
Thank you, sir. And then the other thing is folks, given all the volatility, look, now's the time to really make sure that you don't have too much risk in your portfolio. And the only way to know that is to get a financial x-ray report. So call our office at 382-0037 and schedule your free appointment to get your financial x-ray. Join us on Facebook where we repost these every morning at Statler Financial Services. Like our page there, and then join us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 7:30 a.m.
All righty. Phillip, thank you so much. You say hi to Mickey. Have a great weekend, and we'll catch you Monday morning, all right?
All right. Thanks, Dave. I appreciate it, buddy.
Be well, my friend. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Stop everything.
Hey guys, I want to thank you for joining us today. I hope you got a little bit of information off of it. Again, if you click the link within this post, you can get a free report on understanding market corrections. I hope you have a great weekend. I'll be out on Monday, but I look forward to speaking to you again on Tuesday.